Hey guys, welcome to ADPI again. Believe it or not, the biggest thing that got me excited about real estate, and as boring as it sounds, it's actually taxes. And I don't know what it was I can't remember what it was I heard or read, but I realized, holy cow, the biggest expense in my life is either my housing expenses, living expenses, or taxes, depending on where I'm at in my life. Early on, living expenses is probably the biggest expense, especially when I was W-2 in the military, right? But I realized that as I make more income, taxes is going to be my biggest expense. And I realized this whole compound interest thing that Albert Einstein talks about is the eighth wonder of the world. I realized that if I knew how to not pay taxes, I could compound my wealth exponentially much faster than those that are not good at not paying taxes. And I don't mean tax evasion. You can go to jail for that. I mean tax avoidance, because you're smart, you understand the tax code, and you're probably a real estate investor. So for all those military members out there, veterans, military spouses, and really anybody that wants to learn more about taxes, this lesson is going to go through three primary ways to get better at not paying taxes while you're in the military and after. And then also there's a few bonus things I like to talk about that I'm going to talk about at the end. So without further ado, let's kick it. Oh, and if you're new to our channel, I just wanted to introduce myself. My name is Markian Sich. I'm the founder and CEO of Active Duty Passive Income, or ADPI. And if you're watching this for the first time, know that we are the absolute experts at real estate investing education, how to create more income while you're in the military or after. And we have an amazing resource called ADPIcampus.com, ADPI, which stands for Active Duty Passive Income, campus.com. And so without further ado, let's get into these three items. All right, so number one, and that is capital gains exclusion, which is something that not only military can take advantage of, but because of our military situation, we can probably take advantage of it more often than those that are not in the military, simply because we PCS, we move a lot due to the military. Additionally, the military has additional perks that kind of get layered on top of the typical capital gains exclusion that anybody else can take. And the whole point of this is, okay, let's talk about what capital gains is in the first place. Capital gains is if you acquire a thing, an asset. I don't want to use big words, but just imagine you buy a thing for a certain price and then you sell that thing. The money you made, that delta, the money in between, assuming that you sold it for more than you bought it for, is capital gains. And that applies to real estate. And so when you buy a home and then you sell it for more, you now owe taxes to the IRS. And so the nice thing, though, is your primary residence, which a primary residence is basically the home you live in, has this capital gains exclusion. And it says, hey, if you live in that house for 2 years out of the last 5 years, it needs to be 2 years to the dot, right? Out of the last 5 years, then you can sell that home and not pay the capital gains tax. And at the moment of this recording, if you're single, it's $250,000. That's a big deal that you can not have to pay taxes on. So you could make $250,000 and then not pay taxes on any of that. And if you're married filing jointly, it's up to $500,000. So what that means is this is probably one of the best wealth vehicles for beginner real estate investors, period, end of story, especially with the VA loan, since you can get it $0 out of pocket, 0% down, right? And so if you are PCSing, imagine this, hey, you live in a home for 2 years, maybe 3 years, you PCS. Now, if you sell that home before buying the next one, or however, maybe it's a rental for a while, doesn't matter, you now don't pay capital gains on that. And now you have more cash, and you can buy your next primary residence. Maybe it's a duplex, a triplex, a fourplex. Again, 0% down with the VA loan. And now maybe you have extra cash to now improve that home to really boost its value, really take advantage of what we call meat on the bone, and then do the same thing in the future. Now, you can only do this once every 2 years, but if you PCS, it might work out just perfectly for you. The military side is that you get to add 10 years to that 5-year mark. So as long as you're still in the military, you're moving around, you can actually increase that time horizon, that window, from 5 to 15 years. So as long as you live in your home that was a primary residence for 2 years of the last 15 years, right, and you were forced to move because of the military, you get to claim this same exclusion, which is incredible because, again, these are 6 figures potentially that you could just not pay taxes on. And I'm specifically talking about capital gains taxes. Like if it was a rental for a while, there's this thing called depreciation recapture. I'm not going to talk about that right now. Point is, almost completely tax-free, okay? It's a huge savings. And this is all stuff you can then reinvest. So you got to take advantage of that. And here's point number 2, which kind of layers even further on top of that. So point number 2 is partial capital gains exclusion. Okay. The issue with capital gains exclusion, again, is probably the most limiting factor, which is the 2-year mark, right? Like you have to live in it for 2 years. However, if you're forced to move because of the military, you can now prorate the maximum exclusion, right? Your capital gains exclusion cap, whether it's 250,000 or 500,000, based off of how long you lived in the house. So if you lived there for 1 year, you can now exclude, if you're single, half of 250,000, right? 125,000, or 250,000, which is half of 500,000 if you're married filing jointly. And actually, believe it or not, a lot of tax professionals don't understand partial capital gains exclusion. And sometimes they haven't even heard of it. Like this is literally, I've had these conversations because either they think that you prorate how much you're actually saving. They don't realize that you prorate the maximum. So for example, I lived in a house for only about 18 months, so about 75% of the 2-year mark. I believe the profit was about $172,000 of capital gains. I was able to not pay any taxes on that because I was married filing jointly, and 75% of 500,000, what is that, like 375,000, right? That didn't even come anywhere close to the cap. I got to not pay any capital gains tax on that 172,000. So again, taxes is incredibly powerful. Like these are 6 figures that you can not pay taxes on sometimes, and maybe even not pay 6 figures of taxes based off of your gains. So it's incredibly powerful, and you have to look into this if you're getting into real estate. Otherwise, you're shooting yourself in the foot. All right, so the third best tax benefit for real estate investing is depreciation. Now, it sounds like kind of a negative term, like why would I be excited about depreciation? Well, you should be excited about it is because it is essentially, like you all heard of deductions and write-offs and all that kind of stuff. Well, basically this is a deduction that you take over a period of time, 5, 7, 15, 30, 27 and a half, whatever, multiple years, depending on what the thing is that you're depreciating. In this case, of course, we're talking about real estate. And so residential real estate typically is depreciated over 27 and a half years, which means the government considers this being like a business expense. As long as it's a rental, you're not living in it, right? And they're like, hey, this is a business asset and it's losing its value. It's going to go down to $0 in value over 27 and a half years, which we know as long as we take care of the property, it's actually going to grow in value. So this is kind of ridiculous. But basically, again, the government thinks it's going down in value by that much. So every single year you get to divide the value of the home minus the land, because you can't depreciate that, and divide it by 27 and a half, and that's how much you chop off from your income that you made from the property. So it's basically the passive income that you're making from the property. You can take passive losses, which is this depreciation, against that. And typically with the cash flowing rental property, you're probably going to wipe out all of the cash flow in terms of like having to pay taxes on it. You still put it in your pocket, but that cash flow, all the tax liability is wiped out because of the depreciation. Now, the trick here is that if you ever sell that property, there's this thing called depreciation recapture, and you're gonna have to pay those taxes down the road. However, here's where the stuff gets really interesting. You can actually defer those taxes even further. So this isn't like, you're not really like exempt from these taxes, it's that you're deferring them. And so when you do this with a 1031 exchange is what it's called, you get to take the profits and use a special agent that's going to take those profits and hold them for you and then allocate them to the next deal. It needs to be a like-kind property. I'm not going to get into the details of that. If you want to learn more, you should join ADPIcampus.com, and we talk about this stuff a lot there. But essentially, you get to defer those gains and roll it into the next property, which might be now bigger and nicer, or maybe it's a multiplex or whatever, right? And kind of restart the whole thing where now that's depreciating over the new cash flow that this property is making. And again, you're deferring taxes on paying the income that you're putting into your pocket every single month. And the gains that you make from that, you're not gonna have to pay taxes on. And depreciation recapture, you're not gonna have to pay taxes on because you're gonna kick it down the road maybe another time with a 1031 exchange. And guess what? Someday when you pass away, those tax liabilities go poof. So from the depreciation recapture. So that's really, really, really powerful. This is a massive wealth tool in America. And so I highly recommend asking your accountant, CPA, enrolled agent, whoever your tax professional is, to really look into this strategy with you if you want to do something like that for yourself. Because if you're like, hey, I have this property, I'm thinking about selling it because I think there's more opportunity with the money, the equity that I have in it, but you want to dot your I's, cross your T's on like how your tax situation is going to be, look into 1031 exchange for sure. And also make sure that your accountant is actually counting the depreciation against the income you're making, because the government is going to get their recapture taxes whether you depreciate that property or not. So basically you're required to depreciate the property, which is awesome, because again, then you get to look like you're not making money when you're actually making money. Now we're going to get into the bonuses. So this is a singular bonus, but I'm going to split it into basically two bonuses because it's kind of a robust concept, and it's called real estate professional. And what it is it's not something that you get a license for, or you're not a loan officer, you're not a real estate agent, you don't have to pass a test. What this is it's essentially just saying your activity, the amount of activity you do in real estate, shows the IRS that you are now designated as somebody who's a real estate professional because you spend so much time doing real estate. And what that'll allow you to do, it'll allow you to remove the cap for how much you can claim in losses from your real estate activity. And in fact, those losses basically, and don't quote me on this is just how I understand this working, because it's saved my parents and myself tons of taxes, is now because you're so active in real estate that those passive losses basically turn into active losses and they count against active income. So the reason why, and this is the second part of this awesomeness, is if your spouse, for example, isn't in the military and you are in the military, or vice versa, one of you all can be the real estate professional while the other one still has an active job, right? A W-2. And if you're doing a lot of real estate investing and you're claiming losses because your depreciation is more than the cash flow you're making, right? That can bleed over and deduct against your W-2 or 1099 or whatever, which is crazy. Essentially, because one of you in in a family, in a team, in a spouse real estate investing team that's doing all the real estate, as long as you spend 750 hours on real estate, 500 of which has to be material, you can ask your accountant about how to make sure you're doing this right. And as long as you own at least 5% of equity in those real estate dealings, and as long as at least half of your professional time is spent on real estate investing, you get to become a real estate professional. And again, basically get to a point where you might not pay any taxes at all. My parents, I believe, are basically not paying any taxes at all over the last 4 years, because even though my dad has a teaching job, my mom is a real estate professional, and we claim a lot of losses because we have large properties against all of his income as well, which is fantastic. So they don't pay money on their cash flow, and they don't pay money on my dad's W-2. It's incredible. And this past year, I'm going to be a real estate professional as well. So I highly recommend you also look into this. And again, if you want to learn more about this, because there's tons of spouse teams inside of ADPI Campus, go to adpicampus.com. That's about it. Thank you for listening to this video. As always, like and subscribe. Thank you. Markian Sich is out. Bye.